if you just consider FNB South Africa, they grew the number of customers on a net basis by 1.3 million during the year. And that's a very good performance, especially given that, obviously other banks are responding and, they're offering value propositions and they've reduced the prices of some of their products and so on. But today, if you just look at FNB, they've become the biggest seller of iPads in Africa. At the same time, we've seen a very strong growth in, for instance, the number of smartphones that are on offer. We've seen a significant increase in customers that are making use of the Fuel Rewards program, as well as the e-bucks, which are very important customer retention strategies within FNB. WesBank at the same time has also grown very well, especially on the back of the fact that they are present and very pervasive in the point of sale, in other words, in the dealer network environment. And that's helped quite a lot. And obviously, we've seen a significant benefit from the fact that we have experienced the very low interest rates that we haven't seen in many years. At the same time, I think the business, in terms of executing its strategy, has really been on target.
Yet non-interest revenue is up only slightly, and that despite reining in customers, and that's seeing in turn transaction volume rise. Some would say they would have expected non-interest income to rise even more so.
Well, included in non-interest revenue are private equity realizations out of FNB, out of RMB. Now, in the current year, we didn't have any significant private equity realizations compared to the previous year. In the previous year, we had some major realizations that would typically be included in non-interest revenue. So that was one issue. And if you look at the numbers of non-interest revenue that was generated by FNB as well as WesBank, they're actually quite strong. And you must also consider that as we migrate customers from your normal bricks and mortar banking channels to electronic channels, we offer a much better value proposition. In other words, the increase in the number of customers as well as transactions is not necessarily in a linear correlation with the increase in revenue, because customers get a much better value proposition as they migrate to electronic channels. So that's why the increase we showed is 10% increase in, for instance, non-interest revenue in FNB, as opposed to a significant increase in the number of customers as well as number of transactions. And just speaks to the fact that the fees that we charge customers have actually been reduced across the board.
Just looking at enhancing, your value proposition, as you've highlighted, and impacting your interest revenue down the line has been your decentralized business model. It's something that seems to be working in your favor. If you put WesBank as, one of the businesses that you've managed to leverage off effectively, we've seen WesBank earnings up 40%, home loans though up 1%. So you can see a slight disconnect there. What's the size of your loan book right now and the quality of that loan book as it stands?
Well, the size of the home loans book is just over 110 billion rand, so it's actually quite a sizable book. And WesBank on the other side, the total size of our advance is about 120 billion rand. And clearly, what we have seen with the low interest rate environment are customers who are buying a lot of the consumer goods or durable goods. Motor vehicles, therefore, would be, obviously a big beneficiary of the low interest rate environment, which is why you'd see WesBank do as well as they did. On the other side, in home loans, we've taken a very measured approach. We're not chasing market share for the sake of it, but what we want to do is to make sure that we're exposed to better quality home loans business. And that's why, you'll see a 1% increase in advances in home loans. But at the same time, though, if you look at the increase in profits in home loans, it's actually quite strong at just over 540 million rand during the year. And a lot of that is attributable to the fact that way back in 2008, we took decisions around making sure that we are more exposed to low-risk customers as opposed to higher-risk customers. So we're quite selective in terms of where we are growing.
How's that going to be impacting your exposure to the unsecured lending market specifically? Lots of caution around unsecured lending in South Africa.
Of course, we've also taken a very cautious approach, even though unsecured lending still continues to grow quite nicely, and the margins in that business are actually quite attractive. However, one must realize that unsecured lending activity across the board is quite heating up, and therefore we've taken a rather cautious approach. But it's also important to say that unsecured lending is not just a product that's available to the mass market. We are quite active in the middle income market, especially offering loans to those customers that we are primary bankers of. In other words, these are people that we know, we've dealt with them for many years. We see exactly what happens in the activity of their accounts, and therefore we feel quite comfortable with the quality of our unsecured lending.
So that on the retail side. On the investment side, RMB, I mean, we've seen a weak corporate demand for credit come through, and of course that within a global context that is in the state it is in right now. Do you have any visibility at this stage on when that might turn?
Well, we, through RMB, have done exceptionally well, actually, in corporate lending. 21% growth in advances in corporate lending in an environment where corporates are not necessarily borrowing is really good. Clearly, we expect the economic environment to remain tough, but the focus that we have in RMB is to make sure that we are allocating more capital to the investment grade counters. In other words, identifying companies that we think are going to withstand the tough economic cycle and really providing a more integrated solution and services to those customers has actually paid off quite nicely.
Of course, key as well is return on equity, and you highlighted a phenomenal figure at the start of the interview with regards to return on equity on FNB. You said that up 32%. For the business as a whole, what are we looking at? Because that's a key number to look at, specifically when you're investing heavily into Africa from here on out. We've heard of the investment in Ghana. We know that you're looking at Nigeria quite intently as well.
Yes, we have targeted an ROE of between 18 to 22%. Now, if you look at the end of June, we posted an ROE of 20.7%, which is actually quite good. In fact, it is market leading by a margin. And we continue to focus on that, despite the fact that we're investing in new territories, we're investing in platforms in South Africa as well. And if you look at the approach that we adopt, we always want to be exposed more to businesses that are generating better ROEs. And that's a key measure at Firstrand as opposed to other measures.
Mm-hmm. How long do you give your new businesses to get to that target as well? Because, look, speaking to commentators this morning, they were highlighting that one of their concerns with regards to building up in Africa is that it takes time to build up critical mass, and critical mass is what you need to build up decent returns.
Yeah. I mean, if you just look at our more established operations outside of South Africa, in Namibia as well as in Botswana, I mean, it's taken us about 10 years to get to a level where we have scaled, where we are a seeded player. And therefore, in some of our subscale operations in Mozambique, Tanzania, Zambia, and the same will apply to India, it does take somewhere between 5 years or thereabouts to actually get to the level of ROEs that are very comparable to our more established operations.